Welcome back. With the local stock market down in November, what is our sector specialist, Dr. Ron Bewley of Woodhall Investment Research, now seeing in his econometric crystal ball? And that's not easy to say. How are you, Ron?
It isn't. I'm good, though.
Great to see you, mate. OK, so last time on the program, you actually said, I think we're going to move sideways for a while. We went down in November, so you're on the money there. So in simple terms, what we saw this year, will we see it next year?
We're going to see a reasonable 2014, but not as good as 2013 will be the simple answer to the question.
So don't run away from the stock market, but don't expect it to be as exhilarating.
No, but if you have the skill and the advice, you can do a lot better than an index play. If you don't have the skill and advice, an index play or cash. OK. So if we go to the first chart.
Yeah, chart number one, forecast for the next 12 months, Ron Bewley style.
Just for the viewers, I was reasonably on track the last year or two about where the market's going, so I've got some faith in these numbers, but nobody's got perfect faith.
You're only on here because you actually get it right more times than not.
But on the ASX 200 line, you'll see that there's a 9.6. That's the capital gain forecast. It'll be 10% after today. So the next 12 months, about 10%, plus your dividend of 4.6. That's not bad. Yeah,
but it's not just putting your money in the stock market. Go for an ETF.
But it's not as good as this year. That was more like a 15% plus a 4.5%.
That's 20.
So you won't see as much exhilaration. But what I predict is that volatility will be a lot less. So
that's good.
It'll be a nicer ride. But you've got to wait for the opportunity to get in. And I think I've got an answer.
I might have to create some drama myself. Usually the market gives me the drama, makes it easy. I might have to create it.
I'll try and give you the. But if you look at the two lines above, high yield are things like banks and Telstra and stuff, and others, whatever. So the thing I face is people chasing yield. They want the 5.4 plus franking. That's not bad, but they're only going to get capital gain of say 2.9. With inflation at say 3, it means you get no capital gain, but you get it's like a term deposit. That's fine if that's what you want.
If you're super conservative, play the yield.
But the thing is, if you go on the next line, you lose 2% on the divvy, but you're getting such a big whack on the capital gain. You can sell a bit of that, and you're paying half the tax or whatever. So you can do a lot better by taking a smaller dividend, selling a bit of capital gain, if that's the way you want to go.
Now, this chart here, All Ords long-run trend is 5.1%.
Yes.
Is that the capital gain only?
Capital gain only for the All Ords.
So we throw in dividend of, say, 4 or 5%?
4.5, yeah.
That's where that 10% number comes from.
And that's not bad, but what you'll see is the kink in the middle, if you look at the chart. That's in the 80s.
Very kinky.
It's a massive thing there. But without fiddling the data, because there's no point. The first 80 years gave you 5.1%, and you got exactly the same 5.1% for the next part. So one might think you're only going to get 5.1% going forward, and some people have been saying that in the news recently. I don't think that's the case.
So what will we get?
Well, I'm going to tell you that. See, I've got the 9.6, which is above the 5. Because what happens is...
So this is going to be a kink up or kink down?
No, this is waves around a straight line.
OK, right, But it's going to be above or below this time?
Above.
Yes, I thought you were going to say that.
Oh, no, and that's the forecast of 9.6 is above the 5.1.
Of course it is,
So you get this idea of long-run cycles and short-run cycles. So my normal stuff I come on the programme with are the short-run ones, like within a year. The long-run ones last several years.
Ron, you know, when you tell this story, just for people who might have been with us for the last, since 2008, they might have remembered us talking about this sort of thing when we're trying to hold people's hands to stay in the market. During these kinky times when markets, they do come back.
But that's why I feel a bit boring. I've been saying the same thing for years. It's just
it always sounds different. That's the most important thing,
But if we tend, the next chart is the really interesting one.
OK.
And what you've got here is the mispricing in the long run by taking the actual All Ords index, the price index, divided by that trend line. So how far above the trend are you? How far below, which is what you're asking.
OK.
And I showed this chart first time in March of last year, 20 months ago. And I don't know whether viewers can see, I didn't want to put a circle around it. On the right-hand side, the lowest point there, that was about minus 15%. And I was saying, we've got a 15% take-up, we can go through here.
What year was that, Matt? Was that 2008?
That was March 2012. 12. But we also
the lowest.
Oh, no, we had a
the low before.
On the right.
Right, the last low.
Yes, it was 25% below when we were on the programme talking about it years ago.
And that low would have been 2011, stretching into early 2012 before we kicked off. It was mid 2012 that we started rocketing.
So that was I was on the programme in March and saying it's going to go up. And what you can see now, hopefully, is that the line has almost got back to the solid line,
back to the trend,
which means it's fair price. So
No, do we bounce off that line, or do we usually go through it?
You know, there's a bit of art as well as science in this. If you look all the way back, not every time, nearly every time you go through.
Is it art then?
Bit of art. Yeah.
Okay, right. Okay. Go on.
You tend to go through it and look. Oh, sorry.
It's okay. They remember it.
But it keeps shooting through.
Yeah.
And often as much as 30%, 50% more.
Yeah.
So you can get one, even though you're only getting 5% on average. If you're not greedy and you wait for the thing to crash, you can sell down into profit. And that's what I'm anticipating here.
Yeah.
Is that what we're doing here is by January something we'll be above price, and there'll be a bit of momentum probably taking us up there, and at some point we're going to come back to the 5% and then go under again.
Yeah.
So to me, I'm no longer just hold and set the way I used to think about it. I think one can be a bit more intelligent. So a simple strategy would be, if you've got $100 in the market and then you go, say, 15% above pricing, you might sell a quarter of your stock. If you go 30% above, you made a hell of a profit, sell a bit more. If you go 60% above, sell, keep a bit because you don't know where it's going.
Yeah.
And then buy back in when you're cheap. I did a sum once. If you followed that logic of the last 110 years, you would have made an absolute killing.
But Ron, that's the whole issue around timing. Other people who've tried to time the market have often missed the best times of the market and have been in the worst times and have done well. And that's why a lot of rule of thumbs is time. You're better spending time in the market rather than timing. But you're right. If you can use these kinds of indicators, you can time
and
it
these
better.
helped me in 2007, not perfectly, but I sold a whole load of stuff in November because we were so overpriced. And we bought in March 2009, and I told you a couple of months ago, I sold that banking stock at a very nice profit. So yes, you can't time it precisely, but I'm not greedy, so I want the exact bottom or the exact top. Just make a few bob along the way. So I see that's our sort of long-run view, that things aren't too bad. And the average period above or below is about 18 months. We've just had 28 months below. So it's quite reasonable to think we could have a couple of years going faster than that, but it's not going to last forever.
No. So the most important message for the short-term traders, you've already given them your advice on what they should do. But for the long-term traders who think, well, I'm staying in this market until I get so afraid I'll get out, and then I'll buy back in at the bottom. That would be an ideal long-term strategy.
So if you find out you've made 40 or 50% in 2 years, don't hang on to everything. Don't sell a loss. But if it starts to go down, okay, you could have had a higher price, but just quit, get out.
But of course, we'll be watching every correction and we'll hopefully get it right.
Yes,
that's the main part. Now, your last chart, Exuberance on the S&P 500.
Now, this partially explains today, I think. I did this, obviously, before today.
Okay.
This is going up to Friday close in America. So we're going to American days now.
Right, S&P 500, yeah.
And what you'll see is my magic dotted line, the black line. And that's
6%.
That's 6%. If we hit that, you get a correction. And that's in Australia, that's everywhere. And
we're heading that way.
We're about 4.9, I think, as it is. So there's no room to move up. And if you see, we never went above the 6% to any way of thinking. But I just today treated myself to an orange line for Christmas. See the gold line underneath?
Yeah.
At 5%, because there's no reason why it should be 6% in America.
It's actually a yellow line for our
gold or whatever. Whatever.
So why did you put the 5% line in?
Because it actually hits about 10 peaks then.
Oh, okay.
So maybe I should have had 5% for America, 6% for us.
Yeah.
So we're now we're actually on that line. So I'm going to now say I've got a fudgy magic line in America.
Fudgy.
So somewhere between 5 and 6%. And I think we could get a bit of a correction now. Normally when you hit a point like that, like we did in, I think it was February, March this year, and then we fell down in May,
March,
you could lose 5% quite easily. Yeah. That could be your big buying thing, because you're still going to get the same targets at the end of 2014, but instead of getting the 9.6, you might get a 15%. And that's how to think, is not to be too eager to jump in. Something is going to happen, and all you need is a silly statement over the debt ceiling, a silly statement about the China flyover zones. There are many things that can cause a little correction, and that's your opportunity to get in.
And so, Ron, you still think, in simple summary, a correction is out there. It doesn't necessarily have to be a 10%er, but it could be a 5%er.
Yeah, we don't need one, but America, if it has one, typically spills over into us. So we're actually minus 0.3%, so we're a fair price. So you could buy today quite happily.
In the Australian market.
Yeah, but the chances are, I think, America's going to correct. And that could take us down a bit further, and that will be a buying opportunity.
Okay, Ron, thanks for joining us.
Pleasure, and happy
Always
Christmas.
Fantastic. Okay, mate. Now,